the buy trigger, do yourself a favor, have your favorite LLM X-ray your existing holdings, including your ETFs, your 401k mutual funds. There is a very high likelihood that you do already have exposure to Micron, and that taking in an extra position directly into the common stock may not be the smartest thing to do right now. I was talking with Jan Van Eck last week. Van Eck, as many people know, owns the SMH semiconductor ETF. He's got a very good point of view just on the entirety of the space. Micron, differently from many of the other semi-related companies, is basically going through this massive uptick in earnings growth as a result of price increases. We know a couple of things. The first we know is that's rarely sustainable past a couple of years before other people start coming up with solutions. You can't just take price forever. And they've already taken a ton of price because there are only effectively 2 or 3 suppliers to the space. We also know the programs themselves that are requiring all this memory, the LLMs, the data centers, they will all figure out innovative ways to get by utilizing less memory eventually. It doesn't even take that to happen, Scott. All you need to do is hear one person like a Dario or a Sam come out and say, actually, our new model is going to be 20% more efficient in our memory use. And this stock could be at 700 in 2 seconds. So I don't love the idea of buying Empire State Building charts. And I want you to check and make sure you don't already own it before you buy something that's just 100x'd right before our eyes.
You know, Joe, I was talking with a well-known investor this morning who is as astounded as...
The interesting thing about Micron and all the DRAM suppliers, so it's essentially a global triopoly. With Micron, you have the 2 South Koreans, SK Hynix and Samsung. However, they're commodity chips, and I've been covering Micron since it went public in the 1980s. What is different now is that demand is so strong, and their supply, and that of the rest of their triopoly, is so scarce that they're now signing agreements, and these are big dollar agreements, with all of the major hyperscalers. And these are take or pay contracts that last 3 to 5 years, depending on the contract, and they're locking in prices. This is unprecedented for a commodity vendor. And so right now, multiply it by a traditional valuation multiplier, the stock goes higher. But what happens if this company that used to max out at a 10-time PE ratio, because of this visibility, and I think in a couple of years, about 50% of Micron's total revenues will be from these contracts I've described. And you give it a growth multiple because it's no longer a commodity play because they have the multi-year visibility with locked-in pricing, take-or-pay contracts. Boy, the combination of rocketing earnings and a growth instead of a cyclical multiple, believe it or not, even after this big move, could take this stock meaningful higher.
You talked about that 10 times, and that was sort of the peak that people were referring to, right? And that right in that tech bubble, right, of 1999, you know, when Micron gets up to this point. But to your point, you talked about 1320 as a valuation, and now you've driven your valuation higher based on new numbers. Where is it hovering now?
So at first blush, based on what I heard last night, and obviously I attended the quarterly webinar live, I think 1600 is the next stop, but I can make a case for even a higher multiple.
And how quickly do we get to a number like that?
I think that their peak greatness will not be next year. It'll be their fiscal 28. So between now and then, and you have to remember that this company is not on a traditional calendar year. It has a August fiscal. So I'm talking about the year ended August 28.
I think it was interesting how you brought up the deals that they have, the long-term contracts, paid contracts, 3 to 5 years, and that gives you visibility that you haven't seen before, the likes of this for Micron. But that's 3 to 5 years. Do you expect more and contracts like that because of the supply-demand imbalance?
That's an excellent question. I think the company will throttle it back, and their goal is to have maybe 50% over that time period that I referred to of their total revenues in these kind of contracts, because it's nice to have the visibility, but like anything in life, there's pros and cons. And the con here is what happens if prices continue to rise and they're locked in at lower prices on these deals. And of course, that's why the hyperscalers want to enter into these contracts. And so they give up some upside, right? It's always we sacrifice the upside for the visibility of the floor. And so there could be a quid pro quo. So I think they'd like to keep their options open and have about 50% with these contracts and the other 50% of their revenues without.
So when you look at the group, Micron obviously shining today and getting.
What could derail the AI super cycle? Every major investment boom eventually faces one question: what could go wrong? It's a fair question because no trend move upward forever. Even the strongest bull market experience correction. But when analysts look at AI today, most of them aren't worried about the demand. They are watching something else. Risk number one: regulation. Artificial intelligence is becoming more powerful every month. Government around the world are beginning to pay closer attention. Export restrictions, national security review, advanced model approvals, access to frontier AI systems. These policies are becoming increasingly important. Recent actions involving leading AI companies show the government are willing to intervene when they believe the national security is involved. While safety is important, lengthy approval process could slow the innovation. If frontier AI models take longer to reach the developers, their delay doesn't just affect the software companies. It affects the entire AI ecosystem. Cloud providers, chips manufacturers, data centers, infrastructure builders, everyone. Risk number two: infrastructure bottlenecks. Ironically, the AI industry may not be limited by technology. It may be limited by construction. Building a modern AI factory requires land, power, cooling, networking, permits, transformers, transmission lines, and thousands of specialized workers. Even if demand continue rising, the project can only move as fast as physical infrastructure allows. That's why many analysts believe the utilities and the power companies have quietly become some of the most important player in the AI. Risk number three: investors' expectation. Another challenges come from the Wall Street itself. Expectation has become incredibly high. When companies consistently report record revenue, investors begin expecting perfection. Eventually, even outstanding results can disappoint if expectations become unrealistic. That doesn't necessarily mean the business is weakening. It simply means expectation rose faster than the reality. This is why long-term investors often focus more on fundamentals than daily prices momentum. Risk number four: competition. Competition is increasing across the AI industry. Custom AI chips, open source models, specialized accelerators, new startups, established technology giants. Every year, the more companies enter the race, but many analysts point out an important distinction. Competition doesn't automatically reduce the demand. It's the overall AI market continue expanding, then multiple companies can grow stimulationally. The market doesn't have up to produce one winner, it can produce several. Why many investors remain bullish? Despite this risk, one fast continuous standout is no major AI companies reducing investment. Cloud providers continue increasing the capital spending, and government continue funding AI infrastructure. Enterprises continue deploying AI across their businesses, and memory demand supply constant. GPU demand remain exponentially strong, and new data centers continue breaking the ground around the world. Those are the sign of industry preparing for the contraction. They are the sign of industry is still expanding. The bigger picture: every transformational technology creates uncertainty. The internet did, smartphone did, and cloud computing, artificial intelligence is no difference. There will be a winner, there will be a loser, there will be a setback along the way. But if AI continue becoming a core part of the global economy, then the today infrastructure build out may be eventually be remembered as only the beginning. And that's exactly why so many long-term investors remain focused not on the next quarter, but on the next decade. And if you're watching this video till now, then subscribe our channel and also share with your friends.